Nearly $10 billion evaporated from the Aave protocol in 3 days, and almost no one on the timeline is talking about the mathematical reality of why it happened. Right now, everyday investors are staring at high-yield percentages on their stablecoins, completely unaware that their principal capital is structurally trapped in a $196 million bad debt black hole. While retail is panicking about technical charts or temporary price dips, the actual on-chain data shows a much darker reality. This is not just a standard market correction. This is a highly sophisticated systemic liquidity freeze hitting the monopoly of decentralized finance. If you hold Aave, or if you have any collateral deposited inside its ecosystem, the next few weeks are critical for your capital preservation. The protocol's price action is squeezing within a massive multi-year technical pattern, at exactly the same time its fundamental foundation is being tested like never before. In this video, I'm going to walk you through the raw, verifiable facts. We'll break down the internal research dossier exposing the Contagion, map out exactly what the whales did within 90 minutes of the exploit, and most importantly, I'll share my exact technical roadmap and load zones for how I'm playing this crisis. Let's get to work. Right now, Aave is trading around $85 to $90. To the untrained eye, this might look like a standard pullback in a choppy macro environment. Bitcoin is currently stuck in a frustrating sideways range between $63,000 and $78,000, refusing to make a definitive structural decision. Because of this macro hesitation, altcoins are bleeding out, and Aave is no exception. But there's something in the underlying mechanics of Aave that completely changes this picture. This is not just sympathetic price action dragging the token down with the broader market. This video matters right now because the discrepancy between what the chart is showing us and what the on-chain data is screaming at us is at historic levels. We're looking at a fundamental insolvency crisis masked by technical consolidation. Aave commands a massive 65.9% market share in the decentralized lending sector earnings. Before this crash, it was a highly profitable machine, generating an incredibly healthy $53.8 million in weekly earnings. It fundamentally dominated smaller competitors like Maple Finance. Aave was the undisputed blue-chip fortress of yield. But that fortress has been compromised, and it was not destroyed from within, but through the dangerous reality of cross-protocol composability. Everything changed when the Kelp DAO bridged asset, known as RSETH, was exploited. I want to be clear here. Aave's internal smart contracts were pristine. They didn't get hacked directly. But because decentralized finance is highly interconnected, the exploiter took the stolen, worthless RSETH, bridged it over, and dumped it into Aave as collateral. They used that phantom value to borrow real, liquid-wrapped Ethereum against it. By the time the dust settled, Aave was left holding a catastrophic $196 million in bad debt. Out of an abundance of caution, the protocol forcefully froze RSETH and wrapped Ethereum markets across version 3 and version 4. But the contagion was already spreading faster than human governance could react. Preliminary post-mortem indicators suggest this was executed by a highly sophisticated state actor, likely the Lazarus Group out of North Korea. They exploited the bridge node infrastructure, specifically the Layer 0 network. The market instantly priced the bridge operator as guilty as the lender, sending Layer 0 down 22% and Lido down 19%. This dragged the entire decentralized finance sector into the red. The moment the exploit hit the blockchain, smart money didn't wait for a public relations announcement from the team. Within 90 minutes, whale transactions over $100,000 spiked from an average of 2 to 6 per hour, all the way to 43 per hour. Exchange inflows rocketed from negative $38,000 to positive $3 million in that exact same 90-minute window. Whales instantly drained liquidity across Ethereum, Tether, and USDC. They evacuated immediately, and they left slower retail investors holding the bag. Because of this massive, instantaneous capital flight, Aave experienced a literal bank run. The total value locked plummeted, bleeding nearly $10 billion in just 3 days, with one massive capital outflow of about $5 billion happening in a single day. This created a vicious secondary liquidity contagion. Users who had their funds safely deposited in the protocol suddenly realized they couldn't withdraw. In sheer desperation, we saw a $300 million increase in borrowing against Tether collateral in a single day. Trapped users started aggressively borrowing against their own deposits just to gain any available liquid capital, maxing out the utilization rate of all major stablecoins. Right now, nearly $5 billion is supplied on Aave between Tether and USDC, and every single dollar is borrowed. The utilization rate is locked at 100%. Not a single supplier can get their funds out. High lending yields mean absolutely nothing when your principal is structurally trapped. The desperation has reached the absolute highest levels of the crypto industry. We literally saw ecosystem whales like Justin Sun publicly begging the hacker on social media, offering to negotiate over the counter just to save the protocol. When billionaires are asking state-sponsored hackers for a truce, you know the automated governance systems have lost total control. The math simply doesn't support a clean recovery. Aave's safety module, their internal insurance fund, currently holds only about $50 million. That covers roughly 28% of the bad debt. Furthermore, the protocol's non-native treasury only holds $60 million. Even if they drained every liquid asset they had, they are mathematically insolvent regarding this specific debt hole. The remaining $120 million will likely have to be socialized among staking providers, guaranteeing a brutal haircut for lenders. This entire situation feels exactly like the Venus protocol exploit on the Binance chain back in 2021. The community is practically begging centralized players like Tether and Coinbase to step up and provide a bailout. In the meantime, the free market is trying to engineer its way out. Third-party developers like Fluid are creating secondary markets, allowing trapped users to swap their frozen wrapped Ethereum for liquid assets like wrapped staked Ethereum. Even decentralized exchange aggregators like 1inch have deployed custom Pathfinder algorithms specifically built to help users bypass the frozen native routing and flee the protocol. Yes, network bridging for assets like USDT0 is slowly coming back online, but this is merely symptom management. When you realize Aave has $16.3 billion in active loans, managed by a highly concentrated daily active user base of just 18,000 people, the looming liquidation threat is terrifying. If prices drop further, the unwinding will be violent. That's the fundamental reality. Now let's see how this catastrophic data is printing on the charts. Let's zoom out and look at the weekly time frame, because that's where the real market structure is defined. If we look at the price action since 2020, Aave has been forming a massive symmetrical triangle. I have this marked with the orange dotted lines on the screen. Right now, price is sitting exactly on the lower support boundary of this multi-year macro structure. Inside of this larger triangle, we also have a secondary pattern forming. Since 2024, Aave has been trading inside a falling wedge, represented by the white dotted lines. The current price action is sitting right at the convergence of the lower support for both the symmetrical triangle and the falling wedge. The price is squeezing hard, and a major volatility expansion is imminent. We are ready to make a definitive decision, but we need to look at the momentum. The price is currently trading completely below the 10, 21, and 55 exponential moving averages, which are the blue, red, and purple lines on my chart. It's also trading below the 200 simple moving average, represented by the green line. The trend is undeniably heavy. We lost our last major support zone back in January, and our primary overhead resistance is now firmly established at $128. When we look at our oscillators, the Heikin-Ashi Relative Strength Index, which is the indicator sitting below the price action, is flashing extreme oversold conditions. In fact, it just printed the lowest ratio in the entire history of the asset. For this to revert, Aave desperately needs a strong, high-volume green bullish weekly candle. It needs to reclaim the $100 level just to confirm that any bullish momentum is returning to the market. Let's pull our Fibonacci levels to map the potential downside and upside targets. I'm anchoring the Fibonacci tool from the $128 low in April 2025 up to the $350 high in August 2025. On the upside, our 0382 retracement sits at $240, which perfectly aligns with the upper resistance of our macro symmetrical triangle in case of a reversion. But given the brutal fundamental news we just covered, and Bitcoin failing to show strength above $70,000, my base case leans heavily bearish in the immediate short term. I believe the price action is going to flush downward to search for liquidity. It wants to tap that high demand zone sitting at the 1618 Fibonacci extension, which comes in right around $68 to $70. In fact, I wouldn't be surprised to see it wick down into the $60 range. The market makers love to sweep these obvious pattern supports. My expectation is that price might spend 1 to 3 weeks forming a deviation below this triangle, accumulating liquidity from panicked retail sellers before attempting to return back to the symmetrical triangle. So, how am I actually trading this? I'm a data-driven investor, which means I let the chart dictate my execution, but I use the fundamentals to dictate my risk sizing. Because the fundamental backdrop is highly toxic right now, this is a high-risk play. It represents a very small portion of my overall portfolio. My primary load zone, marked by the green box on the chart, spans from $60 up to $80. I'm dollar cost averaging into this zone by dividing my allocated capital into 3 separate chunks. Capital preservation is always rule number 1, so my hard invalidation level is set at $50. That's my stop loss, marked by the red dashed line. But listen carefully. I require a full weekly candle close below $50 to trigger the exit. Wicks don't count. I acknowledge this is a wide and expensive stop loss, which is exactly why the position size must remain small. If the market respects this deviation and reverses back into the triangle, my take-profit targets are staggered at key structural levels, marked by the green circles. Target 1 is $100. Target 2 is $128. Target 3 is $158. Target 4 is $188. And my final target is $238. As soon as we hit target 1, I'll trail my stop loss to my entry price to ensure a risk-free trade. When we hit target 2, the stop loss moves to target 1, locking in yield all the way up. However, if the broader macro environment collapses, perhaps with Bitcoin falling below $60,000 and my $50 stop loss is triggered, I'll flip my bias. I would look to open a short position targeting the 2618 fib extension down at $25, marked by the red circle. I would execute this with very low leverage, a tight stop, and only after waiting for overbought signals on the lower timeframes to ensure a perfect entry. To summarize my thesis, Aave is caught in a perfect storm. It's bleeding billions in total value locked due to an unbacked $196 million debt hole, while simultaneously sitting on the absolute edge of a multi-year technical support line. The on-chain data points to capitulation, but the technicals offer a highly defined risk-to-reward setup if you have the patience to wait for the liquidity sweep down to the $60 region. Remember, in crypto, the news is always the absolute worst exactly at the bottom of the chart. If you found this analysis valuable, hit the like button and subscribe to the channel so you never miss these data-driven deep dives. And if you're a serious position trader who wants to move beyond YouTube videos and see my exact execution in real time, you need to be inside the Pro Capital Vault. This is my private Discord community, accessible directly through the YouTube members program of my channel. I share my real-time portfolio tracking, the exact buy and sell zones, weekly live strategy calls, a comprehensive Sunday prep report, and direct access to me. It's a space for veterans and serious investors to work side by side with me. Just click the join button below this video, use the link in the pinned comment, or scan the QR code on your screen right now to step into it. Once you join, just remember to sync your YouTube account to your Discord to automatically unlock all the private channels. Finally, if you're looking to generate yield but want to avoid lending protocols right now, I highly recommend watching my step-by-step tutorial on how to build stablecoin liquidity pools. It's a fantastic alternative strategy for capital preservation in this current environment. As always, nothing discussed here is financial advice. This is simply my personal market journal and mathematical approach to the space. Much love for being here, stay disciplined, manage your risk, and I'll see you soon in the next one.